probably having the most immediate impact. That is already hitting our higher leverage borrowers. You think the kind of vintage 2021 deals, those borrowers that didn't hedge heavily and hedge early are really looking right now at an interest rate that's roughly double what their rate was at closing. So if you think of say a 7 times traditional first lien, second lien, 7 times deal, that deal at best right now has an interest coverage of 1.5 times, possibly less, which really does not leave much room for anything else. Doesn't leave a lot of room for capital expenditures, taxes, or what we like, debt repayment. All of that is of course potentially being complicated by a SOFR conversion that's coming and could add to interest rates. As you know, we look at a lot of loans that have fallback language that will put a credit spread adjustment in that at the moment is higher than the gap between LIBOR and SOFR. So we could see those rates pushed a little higher by that conversion process. The second thing you mentioned was GDP contraction. To me, that's really the biggest question mark right now. You know, we're seeing a lot of signs that we won't see a recession, right? We see a strong Q4. I think the revised number this morning was 2.7% growth. Unemployment is at a 50-year low. The consumer appears to be resilient. January had roughly 3% retail sales increase. All of those things certainly don't suggest a recession. Moody's Analytics recently used the term slow session. They're not expecting a decline, but they're expecting certainly a slowdown. I would say our CEO, among many other bank CEOs, is expecting a recession, but expecting it to be mild, likely late 2023 or early 24. And that's, I think, something we have to kind of prepare for. I would say we're not yet seeing a wide impact on performance, but some surprises on CPI and PPI really are kind of raising expectations for Fed tightening, which could potentially push us over the edge. Liquidity, you mentioned, I will say that is has the potential to impact deals that need refinancing. The good news there is there's not really an imminent maturity wall. In Q4, we had kind of an open window and a lot of borrowers were able to refinance or extend. So there's really only, and I use the word only kind of loosely, $79 billion that's coming due through the end of 24, but that's only about 6% of the term loan B market. So we shouldn't see the pressures from a maturity wall. Those that do need refinancing now have to look to other markets. Can they fit into a pro rata bank market? They may need to raise sponsor equity, or they may need to go out and put something like a PIK preferred piece in place to reduce the leverage to fit that bank market. Looking further into 2023 and beyond, I think you may see banks tightening. Banks put a lot of assets on in the back half of 2022 as the term loan B market and the high yield markets kind of backed up. A lot of those deals came onto balance sheets, both in the term of hung syndications and in just revised pro rata deals. Banks are starting to go to the capital markets to raise capital, raising rates on deposits to bring deposits in. You might kind of get the impact of credit tightening as well if the economy weakens. So we may see banks tightening through 2023. Beyond that, eventually the CLO market will return. We just don't know when that really is. CLO issuance is kind of growing in the beginning of the year, but there's still a lot of deals sitting on banks' balance sheets, and it's going to take quite a bit for the CLO market to absorb those. We may see some things like sponsors looking for gaps in documents to do things like prime lenders, which could get interesting. One thing I will say is I don't expect leverage to go back to, say, the 2021 peak levels because the interest rates just won't allow it.